Hello friends, good evening. Welcome to SFM May 2023 RTP. This was a very good RTP. There are few good questions also. So you must practice May 23 SFM RTP before you go to the exam. So today what we'll do, we'll take step by step each question. There are some repeated questions also. There are some new questions also. So I will request you that you download the May 2023 RTP from our website vino.in. We have uploaded this RTP with solution on our website www.vino.in. You will go to the free resource section and you download. It will become easier and faster for you to understand. The RTP is also available on the institute's website. So to understand the chapter fully, the RTP fully, I want that you must keep the printout of RTP May 2023 SM before you. If you can do that, then you will be able to get the full benefit of this lecture. There are total 13 numerical questions which we are going to solve. And how we are going to solve, first we will discuss the question and then solve step by step. The objective is a good revision of SFM plus how to present the answer in the exam. Presentation of the answer in the exam is very important to get very good marks. If some teacher tells you that no, presentation is not important, that is not true, because some students get 5 out of 5 for the same answer and some students get 1 or 2 marks for the same answer, and the reason is that some student may not be able to present the answer properly. So trust me, a good presentation adds extra marks to your exam. Okay. So here we go. I have in front of me RTP May 2023 SFM question number 1. So please come to question number 1. This question is from money market instrument. Money market instrument on commercial paper, a very easy question. And this question is a repeat question. It was asked earlier also. Very easy question. From the following information, compute the effective rate of interest per annum. What we have to compute? Underline, double underline. Effective rate of interest per annum. This is one calculation, effective rate of interest per annum, as well as the total cost of funds to Nirmal Limited, which is planning a commercial paper issue. So what is the information given? Issue price is 487,750. All of you know that commercial papers are issued at a discount to the face value, and the face value is 5 lakh, maturity is 3 months. So basically, in simple words, the difference is the interest for 3 months. Difference is the interest for 3 months on 487,750. So first we will find out how much is the interest for 3 months, and then you have to convert into effective interest rate per annum. In addition to the interest cost, when the company issues commercial paper, there are other expenses that also will have to add. Brokerage is 0.15% for 3 months. Since it is given for 3 months, I will multiply by 4 so that I will get the equivalent brokerage per annum. Rating charges is already given per annum. Stamp duty is 20% for 3 months. It is 0.20%. Please rectify, it is 0.20% for 3 months. So if it is 0.20% for 3 months, to get the answer for a year, we'll multiply by 4. So first what I'll do, step number 1 will be to find out the effective rate of interest, then add these 3 costs also. That will give you total cost per annum, and for that you'll get around 5 marks. This is an RTP question. So marks are not mentioned here, but usually they ask you such question for 5 marks. Write down important question for next exam, question number 1. And those who are writing the answer will write down Step 1, nominal interest. Step 1 is nominal interest, also called bond equivalent yield. Nominal interest or bond equivalent yield. So first we'll find out the interest for this period. Multiply by 12 by n will give you annual figure. So face value minus issue price, divide by issue price, into 12 by n into 100, into 12 by n into 100. So data is given in the problem, 5 lakh minus 487,750 divide by 487,750. So this will give you interest for 3 months into 12 by 3. Make it 12 by 3 into 12 by 3 will give you interest for a year. So that comes to approximately 10.05% per annum, compounded quarterly. Write down compounded quarterly. Your institute answer does not write this. Compounded quarterly. If it is compounded quarterly, how do you compute the effective rate per annum compounded annually? In the earlier exam answer, they used to stop the interest calculation at this point, but nowadays they convert this into effective interest rate per annum compounded annually. So I will have to go one step further. So write down effective interest rate per annum. Effective interest rate per annum. Write down important. Now I have to tell you that earlier they were not doing this calculation, but now they are doing it. So you will also do in the exam. Effective interest rate per annum will be 1 plus this is your nominal interest rate per quarter, compounded quarterly. So divide by 4 to the power 4. Divide by 4 will give you value of 1 rupee after 3 months. And then you have to take the power 4, which gives you effective interest rate per annum compounded annually minus 1. So here the answer comes to 10.435%. 10.435%. Now write down step number 3, total cost of funds to the company. Now this is very easy. Total cost of funds to the company. First we have already computed effective interest 10.435%. Then look at your question. Brokerage is given 0.15% for 3 months. For brokerage I will simply multiply by 4. For 3 months 0.15%. So for 12 months 0.60%. Rating charges already given annual 0.55. Rating charges given per annum. And stamp duty is given 0.20% per annum per 3 months multiplied by 4. So that is 0.80. Now dear student, kindly tell me the total. Please give me the total now. All of you, please tell me the total of this. Yes, total is 12.385%. Total is 12.385%. So this is the answer of this important question for your upcoming exam. Now we'll come to question number 2. Already repeated in the exam. So you will find this question have also been asked in the exam. Question number 2. Following data are available for a bond. So this is a question on bond valuation. Face value rupees 10,000. To be redeemed at par on maturity. Coupon rate 8.5% per annum. Years to maturity 5 years. Yield to maturity 10%. You are required to calculate current price, duration, volatility. So volatility is modified duration. then convexity of the bond, and question number 5, expected market price if there was an underlying decrease in the YTM by 200 basis point. 200 basis point means 2%. So if YTM decreases by 2%, what will be the revised market price of the bond using Macaulay's duration based estimate and using intrinsic value method? Add one more question for my side, which is important for understanding convexity. Using convexity. Point number C, write down using convexity. I am adding this from my side because in the exam they can ask you convexity also. Discounting factor is given at 10%, which I will require for the first few answers, and then discounting factor is 8%, which I will require to calculate the bond value using intrinsic value method. So we'll do little fast. First we will draw a format in which we are going to calculate bond price duration, and also we will try to calculate convexity in this format. Okay, so student who have not done convexity, please follow me. Write down this format. First column write year. First column write year. Second column in bracket write X. Second column write cash flow. Third column write PV of cash flow. Third column write PV of cash flow. Fourth column write X into W. PV of cash flow in bracket write W. Fourth column X into W. This will help you to calculate duration. This will help you to calculate duration. And the last column will help you to calculate convexity. The last column will help you to calculate convexity. So write down year column, cash flow column, PV of cash flow, X into W, and the last column is X into W into 1 plus X. X into W into 1 plus X. I will tell you how to do it. First write down year column. How many years are there? 5 years. So write down 5. 1, 2, 3, 4, 5. Then write down cash flow 8.5% of 10,000. How did you get 850? 8.5% into 10,000. Please note down somewhere. Working of 850. 4 times. In the last year, you will get 10,000 plus 850. That is 10,850. Now in the question, discounting factor at 10% is given. So what I will ask you to do, take this number, multiply by that factor in the question 0.909, 850 into 0.909, 772.65, memory plus, so that the total can be got fast. We can get the total fast. Again 850 into 0.826, 850 into 0.751, factors are given in the book, multiply, use memory plus function. Last one 10,850 into 0.621. Now taking me the total 9431.50. Right below, this is your first answer, current price of the bond. Current price of the bond. Now next task is to find out the duration. For that we'll multiply year into PV of cash flow. For column number 1, column number 3, you will multiply and use memory plus function. So follow me. 1 into 772.65, same, memory plus. 2 into 702.10, 3 into 638.35, 4 into 580.55, 5 into 6737.85. After multiplying, take the total. Any student who can Give me the total of the last column, of the fourth column. So what is the total? What is the total? The total is 40103.35. 40103.35. Check the answer. Is it right approximately? Now next column is important. How to get the last column? That is for convexity. X into W. We will take this fourth column into 1 plus X. X means 1. 1 plus 1 means 2. So student will take 772.65 into 2. If it is written 1, I will take 2 into 2. That is how the formula will work. So this will come to 141545.30. Now take this number multiplied by 3. 2 plus 1 multiplied by 3. So you will get 4212.60. Very good. Take this number 1915.05 into 4. 7660.20. Now take this number into 5 11611.0. Last one, take this number into 6 2,02,135.50. Give me the total of this last column, please. Yes, everybody, please give me the total of last column. The last column total comes to 227,164.60. So this I will require for convexity. This and this two number I will require for duration calculation. Okay. So now next task will be to find out the duration of the bond. Write down duration of the bond is equal to summation PV into year divided by summation PV. Summation PV into year divided by summation PV. So you will write 40103.35 divided by 9431.50. So this is duration 4.252 years. 4.252 years. See the presentation, how you have to write the answer in detail. Now next is volatility of the bond. Volatility of the bond, write down modified duration. The formula is duration upon 1 plus YTM. Duration is 4.252 divided by 1.10. Your YTM is 10% right now. 1 plus 0.10. So duration, modified duration or volatility of the bond is 3.865. What is the interpretation of this? If YTM changes by 1%, the price of the bond will change by approximately 3.865%. Approximately. So this is the meaning of volatility of the bond, that for 1% change in the YTM, how the bond price will fluctuate. Now the next is convexity. So write down convexity. Convexity in bracket write C. Convexity in bracket write C. The formula is equal to summation W into X upon 1 plus X divided by current bond value. Divided by current bond value. Divided by current bond value. So we have computed this number in the previous table, fifth column, and this is the bond price in the third column. So write down the answer 24.0865. This I will use to find out the change in the price of the bond. Now I have to tell you, your institute has used a different formula, but this is also right. and I'm going to prove it when we'll compute the change in bond price, that this also gives me the accurate answer. Okay, so in case if you want to use institute formula, you are welcome. If you want to follow my method or this formula, you are welcome. Ultimately, we will be able to reach the same conclusion about the change in the price of the bond. Okay, so I am going to use this convexity 24.0865. Now we'll have to find out revised bond price. Write down revised bond price. Revised bond price when YTM decreases by 2%. That is your question. When YTM decreases by 2%, meaning the YTM is now 8%. YTM is now 8%. YTM is now 8%. So student will write the formula. It's a little lengthy formula, but it will serve the purpose. A good student will write, using convexity, you have to solve it 3 times. Convexity, Macaulay's duration and intrinsic value. This I have added purposefully in the question to prove that this formula that we have used is correct. It will give us the right answer. Start. The formula for percentage change in bond price is equal to if the bond price, if the YTM goes down, the bond price will go up. If the YTM goes down, the bond price will go up. Hence, the sign is +1. The sign will be -1 if the YTM goes up. The student knows there is an inverse relationship between the YTM and bond price. If YTM goes down, bond price goes up. If YTM goes up, the bond price will fall. Okay, right. +1 into modified duration, +1 into modified duration into yield change in percentage point, into yield change in percentage point, plus C by 200, C stands for convexity, by 200 into yield change in percentage point square, into yield change in percentage point square. Now write down the figures. +1 into modified duration 3.865 into 2, that is change in yield, plus convexity divided by 200 into 2 square. Let us see who will answer first. Let us see who will answer first. Come on, try. Who wants to try? So the answer comes to, for this portion 7.73, for this portion 0.48173. So the final total is 8.21173%. Now it means that if the YTM decreases by 2%, now the meaning of this is, if YTM decreases by 2%, bond price will increase by 8.21173%. So the new bond price will be the price that you have computed already in the step 1 and plus this 8.211%. So write down below revised bond price. Convexity concept gives you more accurate answer, because as you know, the relationship between the bond price and YTM is not a straight line, not a linear equation, but a convex. So that is why we have to give the importance to the convexity of the relationship, and hence this formula. Modified duration, which I am going to discuss after this, that assumes a straight line relationship, which is not true. Hence convexity is a better way of estimating the revised bond price. It takes into account the fact that the relationship between bond price and YTM is not a linear, but a curvilinear relationship. Okay, so revised bond price will be original bond price plus 8.21173%. Check the answer, 10,205.99. You will find that this answer is more closer to intrinsic value. Step number 2 or second method, modified duration method. Now here the revised bond price will be your original price plus 2 into 3.865%. So that comes to 10,160.55. So using modified duration, I expect that the bond price will rise to 10,160. Now intrinsic value method or present value method, which gives me accurate answer. You will find this answer is closer to convexity answer. Let us check. So here the revised bond value will be, what will I simply do? I will take coupon 850 into annuity factor at 8% and 5 year. I will take redemption value into PV factor at 8% and 5 year. Solve. Find out the value. Factors are given in the question. Last line of the question. Take the factors from there. I have taken the factor from there, and then approximately my answer is 10,203.80. 10,203.80. And if you remember, the answer as per convexity was 10,205. These two answers are close. But if you look at the answer by Macaulay's duration method, that answer is having more difference compared to the answer we have arrived by convexity method. So I hope you are convinced now that the formula that we have used, the process that we have used is correct. So don't worry, you can follow this and you can solve in this manner in the exam, and here is the proof that the formula is right. Question number 3. Very easy question from portfolio management chapter. Very easy. Question number 3. Suresh has identified stock of two companies A and B having good investment potential. Following data is available. It's just a mechanical calculation. Year is given, market price in rupees in all these years, and security B market price is given. Now in this question, probabilities are not given, rather number of years are given. So be careful with the formula. It is not a probability based question. Be careful with the formula. Calculate risk and return by investing in stock A and stock B. So basically you have to find standard deviation of A and B, and return means you have to find out the average return of A and B. For that purpose, first you will have to calculate individual years return. First you have to find out individual years return. Individual years return will be P1 minus P0 upon P0. To get the return of 2014, you have to take 18.75 minus 19.60 divide by 19.60. To get the return of 2015, you will take 33.42 minus 18.75 divide by 18.75. This way first you will have to find out the return. So please note down this formula in your notebook. Return of each year will be P1 minus P0 upon P0. There is no dividend in the problem. Otherwise I could have added dividend also. Now next question, risk and return of investing in a portfolio. If the investment is in the ratio of 6:4, so portfolio return, portfolio risk, and what is the better opportunity for investment? So whether you will invest in A or B or the portfolio. So we'll solve by first computing risk and return of the two stocks. Students will write step 1, calculation of expected return and risk. Calculation of expected return and risk. And return will be equal to P1 minus P0 upon P0. So start with the format first. Half the battle is won if you draw the format right, because that will help you to do faster, correctly also. First column year, then write stock A. Under stock A, 3 columns: price, return in percentage, RA minus RA bar square, RA minus RA bar square. That is for standard deviation. Any doubt, ask me, and if you have any suggestion, please reply. Stock B, same format: price, return in bracket R, RB minus RB bar square, RB minus RB bar square. So first we'll copy year from the question. First copy year from the question, then copy price also from the question. Year 2013 we cannot calculate because opening price is not available. So we'll start with 2014. Okay, here I will not calculate because opening price is not available. If you want to write, you can write. Okay. Now how do I get this number? Student will have to participate 18.75 minus 19.60 divided by 19.60 into 100, 4.34% negative. Second time, 33.42 minus 18.75 divided by 18.75 into 100. So that is a huge 78.24%. In this way, do the calculation for remaining years. 27.59%. Yes, come on, next. 1.43. Very good. Next, 3.12%. Negative 22.09%. Take total of this. Take total of this. This will give you total 83.95%. Because we have to just compute simple average. How many numbers we have taken? 5 numbers. Now divide by 6 numbers. Divide by 6. 83.95 divided by 6. So the answer is 13.99%. You can write 14% if you want. Now next is to compute standard deviation, RA minus RA bar square. Type minus 4.34 on your calculator, minus 13.99 and take the square. How do you take the square? Multiply equal to sign. Anybody got the answer? 335.99. Next one, 78.24 minus 13.99 into equal to 4128.06. 27.59 minus 13.99 into equal to 184.96. Now do this calculation yourself and tell me the total. The total comes to 6226.69. I'll come to the standard deviation. Don't take square root directly. That will not give you standard deviation because here number of years are given. It is not based on probability. Okay. Next, go to stock B. Copy the price from question book. Copy the price from question book or RTP. RTP SFM May 23. You can download it from our website www.valuation.com. dot vino.in. Okay, so you can download from there. Immediately go to website, go to resource section, free resource section, and download this. You will find question and answer, both are there. That will save time for you. That will help you to understand also. Okay, now I will tell you one number, how do you get it. First you take 12.80 minus 8.70 divide by 8.70 into 100. So you will get 47.13. Next 16.20 minus 12.80 divide by 12.80, 26.56. Now do this process and you will get these numbers. Check it. Take the total 97.14% divide by 6, 16.19%. 16.19%. Just check this is right. 16.19%. Now what you do, 47.13 minus 16.19 into equal to 957.28. 26.56 minus 16.19 into equal to 107.54. Now repeat this process and tell me the total. The total comes to 3582.17. This way you will write in the exam. Do not take square root of this. That is not the standard deviation. The formula for standard deviation is when number of years are given, when number of observations are given, the standard deviation of A, that is risk of A, is equal to under root summation RA minus RA bar square divide by N. So N means 6 observations. So the answer comes to 32.21%. Check. Now students make two mistakes here. First of all, it does not divide by 6. Sometimes it does not write all this formula and directly does calculation on calculator and write. In both cases you will lose marks. Now repeat this for B. Standard deviation of B. Standard deviation of B. Divide. Again you don't need to write formula, only once is enough. So now the answer this time is 24.43%. So we have got the first answer, risk and return of individual stock. But to get the risk and return of the portfolio, I need to first find out to get the risk between risk of the portfolio, I need to find out the covariance between the two stocks. Portfolio risk is affected by the covariance. Portfolio risk is affected by the covariance or the correlation between the stocks which are included in that portfolio. So this problem will help us to practice covariance also. Write down 4 columns. First column year, second column RA minus RA bar, third column RB minus RB bar, and the last column is RA minus RA bar into RB minus RB bar. Okay. First you write down year. Don't write 2013 because 2013 does not have return, as we have not calculated the return of 2013. Student will keep the previous answer in front of you. What was RA of 2014? RA of 2014 was minus 4.34 and RA bar was 13.99. So for 2014 minus 4.34 minus 13.99, the answer will be approximately 18%. The answer will be approximately 18.33. You are right, 18.33. Come on, next one. Next one, how do you compute 78.24 minus 13.99? So that is 64.25. Next one, 27.59 minus 13.99, 13.60. 1.43 minus 13.99 minus 12.56 minus 12 approximately check minus 10.87, and the last one is minus 36.08. RB minus RB bar. Now the student will go to first answer. In 2014, RB is 47.13 and RB bar is 16.19. So please do the calculation. Approximately you will get 30.94. Then in the next year, it is 26.56 minus 16.19. Take the answer, 10.37. 10.37 approximately. This way you do the calculation for other 4 years. Minus 3.54 minus 30.71 minus 31.25 and 24.19. Very easy question, mechanical question. Only they are testing your knowledge of the formula and can you apply the formula. In the exam time, when you are under stress, you may not know which formula to apply. So practice, practice and practice is very essential for SFM paper. You may be knowing the answer, but sometimes you are not able to complete or do it correctly. Next column, multiply these two. Use memory plus function so that you can do fast. Minus 567.13 minus 666.27 minus 48.144. Then next is 385.7176, 339.6875 minus 872.7752. Take the total. Take care of positive and negative signs, and the net effect is minus 96.3718. Minus 96.3718. Check the total. Check the total. Then write down the formula of covariance between A and B. Covariance between A and B. Summation RA minus RA bar into RB minus RB bar divided by N. This is your total of the previous answer divided by 6 observation. Covariance is written as minus 16.06 percentage square. This is the symbol for covariance. After that, we'll write down step 3, expected return of the portfolio. Expected return of the portfolio is weighted average return. As per the question, 60% weightage is to A and 40% weightage is to B. These are the weights and these are the returns from your first answer. 13.99, 16.19. Hence, you get 14.87. 14.87 is the portfolio return. Can you tell me the formula of standard deviation of portfolio? Come on, I'll wait for you. Formula for standard deviation of the portfolio. Formula for standard deviation of the portfolio. So the formula is under root WA square into sigma A square, weight of A square into standard deviation of A square, plus WB square into sigma B square, plus WA into WB into covariance between A and B. Into covariance between A and B. I hope you remember the formula. If you remember the formula, you will get full marks in this question. Now put the values 0.6 square into 32.21 plus 0.4 square into 24.43 square plus 2 into 0.6. The formula has 2 also here. 2 into 0.6 into 0.4 into covariance is minus 16.06. Students are requested to solve now. Students are requested to solve and give me the answer. The answer is %21.48%. 21.48%. The answer is 21.48%. Just check the answer. Question was advise which is the better option. Now the answer depends on whether you are looking at risk or whether you are looking at return. If you are looking at a higher return, stock B will be preferred. But if you are looking at a risk, the option which has lower risk will be preferred. So in that case the answer is portfolio because the risk is lower. So write down this note. From return point of view, stock B is preferred. From risk point of view, portfolio is preferred because portfolio risk is lower. Question number 4 now. Question number 4 is again from portfolio. Back to back question on portfolio. Oh, and this is a repeat question. They have asked in earlier exams also. So I will just do it little fast because we have done in class also the same question. Following information is available in respect of expected dividend. This time dividend is also there. Market price, and this time you have to apply the concept of probability. Okay. The previous question was without probability, number of years. This time it is with probability. So my formula for standard deviation will be slightly different. Good, normal, bad. These are the probability. These are the market prices depending upon market condition. And these are the dividend company is expected to pay depending on market condition. The existing market price of an equity share is 106, face value 1, which is come 10% bonus debenture of rupees 6 each. So right now the price of the share is 106 plus you are getting a debenture with that price whose face value is 6 rupees. Mr. X Finance Company Limited had offered the buyback of debenture at face value, which means 106 rupees. Understand, 106 rupees is comprising of two financial instruments, a debenture and a share. Debenture can be bought back by the company today at 6 rupees. So if you buy a share at 106 and if you give the debenture back to the company, you will immediately get 6 rupees. So what is the cost of buying share only? The pure cost of buying the share only is 100 rupees. So P0, that is price of the share today, for calculating the risk, return, etc. will be 100 rupees, not 106 rupees. If you write 106 and do the calculation, your entire answer will go wrong, because 106 is not the price of the share, it is the price of the share plus a debenture whose value is 6 rupees today. Find out the expected return and variability of return. Variability of return is standard deviation of the equity share if the buyback offer is accepted by the investor. And then they have added one more question, also advise whether to accept buyback offer. Should you go for buyback offer or not? So that we'll discuss later. Should we go for buyback or not? But first answer first, which is very easy. Calculation of expected risk and return. Students are requested to participate and reply. Calculation of expected risk and return. Right now we are discussing RTP May 23 SFM CA final. You can download this RTP with question and answer from our website vinod.in resource section. Okay, the answers are also I have written and presented there. I have changed the format of the institute answer slightly for better understanding. So write market condition, probability, return formula, write down D plus P1 minus P0 upon P0, then multiply probability into return, you will get expected return, and this last column is for calculating the standard deviation R minus R bar square into probability. R minus R bar square into probability. First two columns copy from the question. First two columns copy from the question. Now we'll compute return. How do you compute return? Your price at the end is 115. Price at the beginning I will take 100 plus dividend is 9 and divide by 100. So this is the working note for this 24%. Similarly, for the second situation, 107 minus 100 plus dividend divide by 100. So I will get 12%. And for the third situation, it is 97 minus 100 plus 3 divided by 100. So I'll get 0. This is the working note for that. In case if the student wants to show the working note, he can show it. Now what I'll do, I'll multiply these two columns, add it. That will give me expected return. So 6%, 6%, 0. So my answer is 12. This is R bar, return of the stock, 12%. Now R minus R bar square into probability, 24 minus 12, 24 minus 12 square into 0.25. So that is 36. Next one, 12 minus 12 square into 0.50. Last one, 0 minus 12 square into 0.25. Take the total here. The total is 72. So the standard deviation will be square root of 72 when you are using probability. When you are using probability, sir, you have divided by number of observation in previous. When we are taking number of years, then divide by n. But when we are taking probability, we don't have to divide by number of observation. because the sum of the probability itself is 1. So the answer comes to 8.49%. Now write down one note why we have taken 100 in the calculation of return. If you want to write, please write. Present market price of the share. Present market price of the share is rupees 106. Is rupees 106 come bonus debenture of rupees 6 each. Is rupees 106 come bonus debenture of rupees 6 each. Hence net cost is rupees. Hence net cost is rupees 106 minus 6. 106 minus 6 is equal to rupees 100. Is equal to rupees 100. Now the next question is whether the investor should go for buyback offer. Whether the investor should go for buyback offer. So the answer depends on first what is the opportunity cost and what is your maturity period. The debenture is giving you 10% return. That means if you can invest your money at a higher than 10% return, you can go for buyback. Like in this example, the stock is giving 12% return, whereas the debenture will give you only 10% return. So therefore, one can think of going for buyback, surrender debenture, get cash, and you can invest in the share where you can earn a higher return. So the decision regarding buyback will depend on, write down, maturity period and opportunity in the market. So as I told you, if the opportunity cost is high, more than 10%, you can opt for buyback. Again, if the maturity period is low, one can wait. If the maturity period is 6 months, 9 months, 1 year for debenture, then maybe you can wait and you can get 10% return. So if the opportunity rate is very high, go for buyback. If maturity period is very high, go for buyback. But if maturity period is low, you can wait. So that was the answer of this question. Now we'll take a very important question on mutual fund, which requires reverse working. Very, very important question. If you have not done it before going to the exam, then trust me, you will be taken for a surprise in the exam. Then you will probably find it difficult to solve because it requires reverse working. Normally in the class what they teach straight calculation, but when they ask you to do reverse calculation, many students are not able to solve. So I will sincerely request you that you must solve this question before you go to the exam. One more star. Okay. So we are starting one test series for students appearing in May 2023. Okay, and we are going to conduct test series on FR and SFM. There are 4 test series in each subject. I have designed the paper and I will check the paper. The special thing about our test series will be most of the question would be new type. You can see in the RTP, MTP most questions are repeated, but in the exam you get new type of question. So I have found new type of question. More than 90% question will be new for you, which were not asked in the earlier exams. So therefore, you need to learn the surprise element in the exam, and for that you should join the test series. You can take the admission for test series on our website vino.in. On the home page there is a test series section. You can appear for only 1 or 2 or 3 or all the 4 test series. Is it right? And I will check the paper and return the paper as early as possible. at the max by 6 to 7 days, but that is very high. Maybe I can check it in 2 days also, 3 days also. And another important thing is that I will give you good feedback for improvement. It is better that paper is set and corrected by the faculty who is teaching that subject. That will give you an extra edge over other students. So if you diligently appear for the test series, you can move from 40 to 70 marks also. We have covered all the topics, no repetition of any question, so that you will get all the new questions. Okay, so let us come to this question. Messrs. Corpus and AMC on 1/4/15, underline 1/4/15, this date is required for calculating number of years, has floated two schemes, dividend plan and bonus plan. Then Mr. X, an investor, has invested in both the schemes. Following detail except the issue prices are available. In all question you have solved in classroom, probably they have given you issue price here, and you had to compute the yield. This time reverse. Issue price on the first day is missing. Return is given to you. So do reverse working and find out what is the issue price. Then on 31st December, you have bonus ratio 1:4 for bonus plan. On 31/3, you have dividend at 12%. On 31st March, 10%. Like this they have given. Additional detail. Investment made on 1st April was 9,20,000 and 10 lakh. The average profit over these years means 5 years. Can you see 5 years? Investment was made on 1/4/15 and the last date given is 31st March 2020. So 5 years. Over a period of 5 years, this is your total profit, average profit. If you multiply by 5, will give you total profit in this period. And then average yield here is given 6.4. If you multiply by 5, this will give you total yield over this period. This is for dividend plan and this is for bonus plan. Okay, they have not written the heading properly. You are required to calculate the issue price on 1st April. Now this question has a small mistake. This dividend plan is actually dividend reinvestment plan. Is actually dividend reinvestment plan. When we looked at the ICI suggested answer, we found that it is a dividend reinvestment plan. Okay, which means that first the dividend will be calculated and units will be issued to you, which will be added to your opening units. So the number of units will keep on increasing. After every dividend payment, the number of units will keep on increasing. So what I will have to do, using this information, I have to first find out how many units were there at the end after 5 years, and then do reverse working and find out how many units were there at the beginning. 9,20,000 was your investment. Divide by number of units at the beginning will give you the opening issue price or NAV. So reverse working problem are difficult in the exam. First you write down, one by one we'll solve. Point A, write down. First we'll solve dividend plan. Actually it is a dividend reinvestment plan where the dividend is reinvested and additional units are issued. Dividend reinvestment plan. Under that write down step 1. Step 1. First we'll calculate number of units on 31st March 2020. Number of units on 31st March 2020. please inform your friends also. They will also enjoy this lecture. Immediately inform your friends also. Now write number of units. So how do we do? First I will find out the total value of investment after 5 years. Opening investment value is given. Average profit is given. So multiply by 5 will give me total profit. Investment plus total profit will give me total investment value at the end, and divide by the NAV on 31st March, which is 49 rupees, will give me closing unit. So easy, right? So first write down average annual profit. Question in front of you. This is, as I am telling you for one more time, a very important question. 27748.60. Point B, write down number of years. Point B, number of years. Number of years 5. Total gain. Total gain over a period of 5 years. Total gain will be 138743. Just multiply by 5. So over a period of 5 years, this is the gain. Add the initial investment amount. Add the initial investment amount, that is 9,20,000, and that will give me the total value of investment. That will give me the total value of investment, which is C plus D. Just take the total 10,58,743. Now NAV on 31st March 2020. Look at the dividend plan column. The NAV is 49 in the last line. So that means can I calculate the number of units on 31st March 2020? The answer is yes. The number of units on 31st March 2020 will be E divided by F, 21607. 21607. Right? Now I will use this number 21607 and find out what was the units on 1/4/2015. So reverse working we have to do. This is after adding the units reinvested. So I am going to tell you something which, if you are interested, can write down, will help you a lot in the exam. This question was for about 10 marks and very few students were able to get it right. Step 2. In a dividend reinvestment plan, when you are doing reverse working, step 2, how to calculate units. How to calculate units before dividend declaration. How to calculate units before dividend declaration. We have to solve an equation. So let units held before dividend declaration be X. Let units held before dividend declaration be X. Therefore, unit held before dividend declaration plus unit reinvested is equal to closing unit. Unit held before dividend declaration, assume X, and the units reinvested will be number of units into dividend per unit divided by NAV. Number of unit X into dividend, total dividend, divided by NAV, that is your additional number of units, and that will give you units after dividend declaration. Closing unit means dividend after dividend declaration. So what I'll do, I will just make a small equation. So this is NAV into X plus X into dividend divided by NAV is equal to closing unit. So basically my intention is to find out the value of x. Now simplify. When you simplify, x is common. So it is x into NAV plus dividend is equal to closing unit into NAV. So now the student can guess x will be equal to closing unit into NAV divided by NAV plus dividend, because I have not done anything. Just to make your life easy, I have found an equation to calculate the number of units before dividend declaration. X is equal to closing unit into NAV divided by NAV plus dividend. Now if I write this directly, you will not understand. So what I did, just to convince you, I have derived the value of x, and now for calculation purpose we can just make a table and find out the number of units before dividend declaration on 3 different dates. So are you ready? Yes sir, we are ready. Go ahead. So write down number of units on 1/4/2015. Draw one table. First column write down date. Second column write, this time we have to do reverse working. In the class we are doing straight calculation, but this time reverse gear is always little difficult. Units held after dividend. Third column rate of dividend. Fourth column dividend per unit. Fifth column NAV, and the last column unit held before dividend. Units held before dividend will be B into E divided by E plus D. B into E, unit held after dividend, into NAV divided by NAV plus dividend. In the denominator you have D plus E. Okay. So student will do reverse working. First you go to 31st March 19. Question in front of you. This is RTP May 23 SFM. Question number 5. So 31st March 19. This unit we have already calculated in the previous table. Dividend rate is 15%. We have to do reverse working. Take the last date. Dividend is 1.50. So NAV is 45. So student will help me and calculate the last column. Anybody for the last column? Just a second. $20910. Now next is 31st March 18. Rate is 10%. 1 rupee dividend. NAV is given 50 rupees. So apply the formula. B into E divided by E plus D. So you'll get 20,500. Next is 31st March 17. Do the same calculation and your answer will be 20,000. So 20,000 units were held on 1st April 2015, and you have invested an amount of 9,20,000. So 9,20,000 was invested for acquiring 20,000 units. So my first answer is over. For dividend reinvestment plan, write down calculation of issue price on 1/4/15. Calculation of issue price on 1/4/15. Initial investment 9,20,000 is given. Very good. Then unit purchased we have got just now. How much? 20,000. So who will reply first? Come on, everybody. What is the issue price? What is the issue price? Yes, please reply on your chat box. You can write the answer. 9,20,000 divided by 20,000. Come on, reply. The answer is 46. Very good. The answer is 46. Now we'll come to bonus plan. Part B, which is much easier than dividend reinvestment plan. So here we'll have to compute total number of units held on 31st March 2020. You are given initial investment in the problem. You are given average annual yield 6.4%. Multiplied by 5 if you do, you will get around how much? 32%. So you will get the closing investment value. Divide by closing NAV will give you closing unit on 31st March 2020, and then we'll do reverse working. Okay, very easy. This part is easy. Investment 10 lakh, average yield 6.4%. Average yield 6.4%. Number of years 5. So investment multiplied by average yield into 5 will give me total gain over a period of 5 years. Total gain over a period of 5 years is how much? Multiply the three numbers. 3,20,000. So you have invested 10 lakh. You have gained 3,20,000. The value of investment on 31st March 2020 will be, come on student, you will add this 10 lakh plus this 3,20,000, 13,20,000. And what is the closing NAV given in the question book? Closing NAV is given for bonus plan, last line, last column, 44. Therefore, I can compute now number of units. Yes, please reply. Number of units. Number of units. 13,20,000 divided by 44 will give you 30,000 units. These 30,000 units were held on 31st March 2020 after considering that bonus given 2 times. 1:4 ratio and 1:5 ratio. So now I will do reverse working and find out the units held on 1/4/2015. Write down step 3, units held on 1/4/15. Draw the table, write nicely. Good presentation gives you extra marks. Date, unit held after bonus. Unit held after bonus. Bonus ratio. Bonus ratio. And the last column, unit held before bonus. Unit held before bonus. So if suppose before bonus it is X and the ratio is 1/4 of X. So that is equal to 5x by 4. That is equal to 5x by 4. So if it is X before bonus issue, it is 5x by 4 after bonus issue. So if I multiply this by 4 by 5, I'll get the value of X. So I will have to multiply by 4 by 5 if it is 1:5, I have to multiply by 5/6. I have to multiply by 5/6 to get the unit before bonus issue. To get the unit before bonus issue. So 30,000 into 5/6, 25,000. Now 25,000, 1:4. I will multiply by 4/5, 20,000. So the answer is, at the beginning on 1/4/15, 20,000 units were acquired. Now the last answer, what was the issue price? We have invested 10 lakh. We have invested 10 lakh. We got, how many units we got? We got 20,000 units. Okay. So now school level student will answer. What was the issue price? The issue price is A divided by B, 50 rupees. A divided by B, 50 rupees. That was the issue price. So we got the answer. That was quite a lengthy answer. Now we'll come to question number 6. Students are requested to follow me, write in the notebook, download the RTP May 23 from the website vino.in. Okay. We are also going to start test series. You can take admission for test series on our website vino.in. Paper will be checked by me. It is prepared by me also and will be returned to you within 6 to 7 days maximum. Question number 6, write down again. Very important for your upcoming exam. This is also from past exam. Most of these MTP were from past exams, but very good collection. You must practice it. It is like a quick revision of all the topics. Underline a 2 year. This is 1 year. This is second year. 2 year tree for a share of stock in ABC is as follows. This is a multi-period binomial model. Today the price is 100 rupees. 1 year later it can go to 108 or it can go down to 95. After 2 years it can go to 116.64 or fall to 102.60. If it is 95, it can go to 102.60 or it can fall to 90.25. Consider a 2 year, underline American call option. American option can be exercised anytime. American option anytime. European option expiry date. So you can either exercise here or here or here or here or here or even here also. So at each node, these are called node, we are going to check what is better. To exercise now is better, to exercise later is better. Okay. So the question is, consider a 2 year American call option on the stock with a strike price of 98. The current price is 100 rupees. This is 100 rupees. Risk-free rate is 5% per annum, continuous compounding. E to the power 0.005 is 1.05127. So that means this is a future value factor. For it should be e to the power 0.05. There is some typing mistake. Assume 2 time period of 1 year. Underline, means each period will comprise of 1 year, because that is usually the query of a student. Why we have taken 1 year? Because total is 2, divide by 2. So each period will comprise of 1 year. Using binomial model, calculate the probability of price moving up or down. Very important. First we have to see what is the probability that the price will go up or the price will come down. So any student of option valuation model will know the formula for this. And then what is the expected payoff at each node? So what is the value of this node, this node, this node? Round off to 2 decimal points. So very easy question on American option. The student will first write down step 1, calculation of probability of price increase. Calculation of probability of price increase. P is equal to, I hope you remember the formula. We are not doing it for the first time. We have done several times in the class. P is equal to R minus D upon U minus D. R minus D upon U minus D. What is R here? R means what will be the value of 100 rupees after 1 year when compounded at 5% per annum. Value of 100 at 5% per annum compounded continuously after 1 year. D means what will be share price if it goes down. U means what will be share price if it goes up. So 100 into e to the power RT minus 90 is the 95. It should be 95. My mistake in writing here. 95 divided by 108 minus 95. Solve it. 100. This factor is given in the problem. Minus 95, difference between these two, 13. So I have written 0.78 in 2 digits. You can write in 3, 4, 5 digits, no problem. Then the next is step 2, probability of price moving down. Probability of price moving down, 1 minus P. 1 minus P. Go to the previous step. The probability of price going up P is 0.78. So this is 1 minus 0.78 is 0.22. 0.22. Step 3, write down PV factor. PV factor in case of continuous compounding is 1 upon e to the power RT. 1 upon e to the power RT. 1 upon, the factor is already given. This value is already printed in the question. 1.05127. Question in front of you. Without question, you will find it difficult to understand. 0.95123. Now go to step number 4. Go to step number 4. Write down payoff on expiry. Payoff on expiry. Payoff on expiry. What is the exercise price in this problem? Exercise price, write down 98. What is the type of option here? Call option. Call option means it will be exercised if the market price is more than 98. If the market price is equal to or below 98, call will lapse, zero value. Okay. So I will request the student to draw this diagram again. And you also write down the probabilities next to that branch. Also write down the probabilities next to the branch. Very important question. Very likelihood of getting asked in your exam. Okay, now I'm going to ask you a question. Exercise price is 98 and market price can be 106.64. So if I wait till 2 years, what will be payoff? 116.64 minus 98, because it is more than 98. So the payoff at this point will be 18.64. What will be payoff at this point? 102.60. Market price is more than 98, so call will be exercised and the payoff will be 4.60. What will be payoff at 90.25? 90.25 is below 98. It will lapse, value is 0. Call option will have 0 value. So now what I have to do in American option, I have to find the value of the option at this point. The value of the option at this point will be, because it is an American option, you can exercise at any point of time. So higher of the two I will take. I will take that value which is more profitable to me. So if I exercise at this point, I'll get 10 rupees. But if I exercise after 2 years, I will get either 18.64 or 4.60 with a probability of 0.78 and 0.22. So if I wait till the end of 2 years, the answer is 18.64 into 0.78 plus 4.60 into 0.22. But this value is after 2 years and we are comparing it with one value of 1 year. So I have to multiply it by PV factor also, because I have to pull it from 2 to 1. I have to pull it from year 2 to year 1. So I have to also multiply it by 1 year PV factor, and then we'll see which value is higher. The one which is higher is the value of this node N2, which is also your question, right? So write down expected payoff at node N2. Question in front of you. Expected payoff at node N2. Expected payoff at node N2 is higher of, why higher? That value which is more profitable will be exercised. So if I exercise at this node, immediate exercise, I will get 10 rupees. If I exercise later, I will get this value, but this value is after 2 years, so I will multiply by 1 year factor, because I am moving from year 2 to year 1. I am moving from year 2 to year 1. So solve it. Let us simplify this. Immediate exercise is 10. Later exercise value is 14.792. Later exercise value is 14.792. So I will take 14.792. So this is the value of N2. In the same way, you write down please expected payoff at node N3. Come on, keep writing. Keep writing. Those who are watching this lecture, also share with your friend. Please subscribe to this YouTube channel and we will come out with more lectures useful to you. So what is the price at N3 in the diagram? The price at N3 is 95. Exercise price is 98. So immediate exercise means the option is not worth exercising. It is share price is below exercise price. So value is 0 for immediate exercise. If you exercise later, you will get 4.60 or 0 with these probabilities, and this is PV factor 0.95123 PV factor. So I will request the student to solve it themselves. So you will have to choose between 0 and 3.41. 0 and 3.41. So the value of node N3 is 3.41. So now we have got the value of N2, N3. N2 was 14.792, N3 is 3.41, and we have to now go to N1, and these are their probabilities, 0.78 and 0.22. So the value of N1 will be again the value at this node, or value of 0.78 into this plus 0.22 into this into PV factor, whichever is higher. So write down the last part of this answer. Expected payoff at N1. Expected payoff at N1. Expected payoff at N1. Higher of 0. Why 0? It should not be 0. Just remove this. 100 minus 98. 100 minus 98. 2 rupees, because at 100 rupees the call has a value of 2 rupees. 100 minus 98, 2 rupees. If you exercise later, this will be the value of later exercise. So you have to simplify. You will get higher of 2 comma 11.69. Higher of 2 comma 11.69. So 11.69. This is the answer of this wonderful and very wonderful question number 6. Any query on this? If you have a query, you have to WhatsApp 97669 21860, or you have to email Vinod_CA at yahoo.com. Okay, so doubts can be resolved on this by contacting on WhatsApp or email ID. Now next question number 7. This is also a repeat question. Long back it was asked, and such question they ask again and again on future. Very easy question. Shyam buys 10,000 shares of X Limited at rupees 25 per share and obtains a complete hedge of shorting 400 Nifty at 1100 each. So shares long position and future short position. If the price goes up, profit on share, loss on future. If the price goes down, he will have loss on share, but to some extent it will be compensated by gain on future. It will be hedged by gain on future. He closes out his position at the closing price of the next day when the share of X Limited has fallen by 4%. This has gone down by 4%, so loss on share, and Nifty future has dropped by 2.5%, so there will be a gain. So the student will have to calculate loss on share, gain on future, and what is the overall profit or loss from this set of transaction. Very easy question, bonus mark. Is it right? So who will reply? I'll wait for your answer. What is your net gain or net loss? What is your net gain or net loss? What is the net gain or net loss? Come on, reply fast. So write down like this: calculation of gain or loss. Just three lines. Just three lines. First point A, write down loss on cash position. Cash position loss because share price has gone down. You have a long position on share, so you will have a loss equal to, take on your calculator, 10,000 into 25, 10,000 shares into 25, and it has gone down by 4% into 4%, so 10,000 loss. In future you have short position. If the future price goes down, you will have gain because you are short position on future. You have a short position on future. A short position holder gains if the price goes down. 400 into 1100 into 2.5%. So there is a gain of 11,000. There is a gain of 11,000. So now the net gain is 1,000 rupees. Net gain is 1,000 rupees. Just three lines. Okay. The answer is over. The remaining question we will take in SFM RTP May 23 part 2 coming soon. So I will make an announcement of the second part. So you subscribe to our YouTube channel AS Foundation and you will get a notification. Keep the notification on. We will take part 2 very soon. Okay, so thank you very much for watching this video. I wish you all the best for your exam. Thank you very much.